today's market does not remind me of March of 2000 at the peak of the Nifty 50 internet bubble or the, right before the global financial crisis. It is a fairly richly valued market, but I think justifiably so.
Part one of our interview with Whitney Tilson is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. The times they are a-changin'. Volatility is back in the markets. Inflation appears to be cooling. The Federal Reserve is about to change course and cut rates instead of raise them. Both government and consumer debt are soaring. It's a presidential election year with a new candidate. The threats of war are rising. And as JP Morgan is alleged to have said, the market is going to fluctuate. Well, as Wealth Track celebrates its 20th season this year, we are asking some of our earliest guests to join us to get their perspectives on the markets and investing. And this week's guest is one of them. He is Whitney Tilson, who has pretty much done it all on Wall Street. Currently, he is editor and lead analyst of Stansberry's Investment Advisory, the flagship newsletter of Stansberry Research, which provides investment research and advice to subscribers. Tilson also publishes Tilson's Daily, a free daily newsletter of his own, which is widely read by professional investors. And when we first interviewed him here, he was the founder and portfolio manager for Case Capital Management, which he ran for nearly 20 years, overseeing several value-oriented hedge funds and mutual funds. Tilson is a prolific writer, columnist, and author of 4 books, most recently The Art of Playing Defense, How to Get Ahead by Not Falling Behind. A Warren Buffett acolyte, he also contributed to Poor Charlie's Almanac, the definitive book about Warren Buffett's late business partner. I began the interview by asking Tilson to explain one of his current views of the market, that there are signs of a quality bubble.
The kind of businesses that I much prefer to own, some of the world's greatest businesses, have just soared in value significantly beyond their growth in revenues and earnings and so forth. The multiples have gone up a lot. And as investors in some companies are discovering, the company has a little hiccup and it goes from trading at 35 to 40 times earnings down to 15 to 20 times earnings. And now you've lost half your money. It's not a bubble in the sense that these are worthless companies and they're going to zero. It's just a bubble in valuations. And I think we saw that when Warren Buffett dumped half his Apple stock recently. He still loves the company, to be sure. He still owns an enormous position, but he bought it at a little under 10 times earnings, and today it's trading at 33 times earnings. He figured correctly, I think, time to take half my money off the table and bank, the better part of $100 billion in profits.
And when you are talking about quality, all right, Apple is one example. What do you mean by a quality company?
Well, let me give another example. And this is Warren Buffett's longtime partner before he passed away, Charlie Munger, one of my heroes and mentors along with Buffett, was only on the board of just a very handful of companies in his entire lifetime. One of them was Costco, a company he admires enormously, and I consider it one of the great misses of my investing career, that I've been a loyal customer of the company and admired the company. It's such a ferocious competitor. There was once a headline in Fortune magazine that said, "The only company Walmart fears," because Costco delivers more value to its customers than even Walmart. Yet I thought 26 times earnings was too expensive for it to pay for the stock during my entire investing career of almost 2 decades. And today it trades at north of 50 times earnings. It's doubled the earnings multiple from what I already thought was a pretty rich price. Now, I think Costco is going to continue, its earnings are going to continue to grow, still an insanely great company, but I think investors paying north of 50 times earnings today are going to be disappointed.
What would you do then, for instance, with a Costco? I mean, I remember hearing Warren Buffett saying something like, I buy a business to hold forever. What about that theory or that sentiment?
When I was managing money, I used to figure, well, if I wouldn't buy more of a stock today, then it's fully valued and I should sell it. And that was a very, very large mistake. The key to long-term investment success is to let your winners run. So my answer today in saying I would not buy Costco today, no chance of that at today's price, as much as I admire the company. If I had owned it for the last 20 years and was sitting on 20x gains, I would not be rushing to dump it at all, but I might do what Buffett's done. I might sell half of it. I might put in a trailing stop and sell a portion of it, to lock in gains. That's what I've been advising my readers, for example, to do with NVIDIA. Another incredibly great company, but it's one that reminds me of Cisco back in 1999 or early 2000 at the peak of the internet bubble, when it went up to trade at 150 times earnings. Earnings have grown wonderfully over the last 25 years. The company's done great, but investors still are down by 50%. 25 years later, investors were correct that the internet was going to be a big thing. They were correct that Cisco would make the piping for the internet with their routers and all, yet they still lost half their money because it went from trading at 150 times earnings to 20 times earnings or something like that. And almost no amount of earnings growth can make up for that. So I would generally avoid the most popular stocks, and instead I would look for the fallen growth angels. Nike and Starbucks were both trading at 40 times earnings not too long ago. Today they're trading at high 20s and even low 20s in the case of Nike. Investors in those companies thought that these companies were inevitables. These stocks got caught up in a quality bubble. Yet investors have lost, the better part of half their money because these two companies encountered stumbles. And there's a lot of room to fall when you're trading at 40 times earnings.
Speaking of the quality bubble, how concerned are you about that impacting the rest of the market, or is it reflective of what's going on in the market as a whole? Is it a danger signal for investors in any way?
I'll answer that question in two ways. The first way is only about once every 10 years do I make a big market call. I'm a bottoms-up stock picker. I look at individual companies, try and buy quality companies at reasonable prices and hold them for a long period of time. That's what I think any sensible investor should do. That's what Warren Buffett's done his entire career. I am not seeing a general bubble out there in the marketplace. Today's market does not remind me of March of 2000 at the peak of the Nifty 50 internet bubble, or right before the global financial crisis. It is a fairly richly valued market, but I think justifiably so. The U.S. economy is actually doing quite well. Corporate profits are doing well. Corporate balance sheets are strong. But I would just caution investors, don't chase whatever's hot. They sure got burned chasing meme stocks and SPACs a few years ago. Today, I think investors who got burned sort of fled to higher quality companies, the mega cap tech giants, the NVIDIAs and the Apples today. I'm seeing small cap stocks, traditional value stocks today, trading at relative discounts to growth stocks and big cap stocks that remind me again back of 1999, 2000, when value stocks and smaller cap stocks had a tremendous run, tremendous outperformance after the bursting of that bubble.
Define what a quality company means to you, the kinds of companies that you're looking for.
There's no secret sauce here.
Right.
I'm looking for the same things everybody's looking for. A company that has a strong brand, a product either that delivers enormous value or has a proprietary moat, like a patented drug like Lilly and their Mounjaro and their weight loss drugs. The obvious companies, ranging from super high margin businesses like pharmaceuticals or, Microsoft and Meta and Alphabet and Apple, or companies like Costco that make very slim margins, but that's their competitive advantage. They're the low-cost provider, right? But companies mostly that have a long growth runway in front of them. I would say the second biggest mistake in my investing career, if the first one was not letting my winners run. It's so painful to me to admit that I owned Apple at 35 cents 25 years ago. All I had to do was hold those shares and I'd be flying around in a private jet today, right? I owned Netflix at $8. I owned Amazon at $2.40. I owned McDonald's and Home Depot and some of the world's greatest companies, but I doubled my money and I didn't want to be greedy, right? My second biggest mistake is not appreciating that the price you pay for a stock today is important, and you don't want to pay 50 times earnings for almost any company. On the other hand, the quality of a business and how well it performs, how much it grows over the next 5 or 10 years will swamp almost any valuation. Not Cisco, it won't swamp Cisco at 150 times earnings, but I was too focused on buying a stock at 15 times earnings or less, let's say, when I should have paid up for Costco at 26 times earnings because it's that insanely great a business and had that long a growth runway. You know, I'm talking 20 years ago, and the stock's up 20x since then. So I'm today much more willing to pay up for quality and focusing on how much a company can grow. If a company grows its earnings from $1 a share to $5 a share, that stock is going up. And conversely, if I pay 3 times earnings for a company, but its earnings go from $5 a share down to $1 a share, that stock's going down. That's a value trap, right? So I'm much more today focused on buying quality companies, but part of that quality is that they have a competitive moat that's going to allow them to grow at a good rate for a long period of time. That's the key to making a lot of money in the market. Finding those companies, not overpaying wildly for those stocks, but being willing to pay up for those stocks, and then very importantly, holding them for many, many years.
And that's what I'm hearing, holding them for many, many years. So it's one thing to go into an Apple now when it's trading at these valuations, but I'm trying to figure out, if you're holding them for many, many years, why then sell an Apple, for instance, when it gets richly valued? I mean, you know, you talk about to your newsletter readers, you know, compounders, and as you just said, focus on the long term. So why not just, as you also said, let those winners run? Why bother to get out when there are very few companies in the, you know, in the scheme of things that are actually going to deliver these compounding effects over time?
Well, I think Buffett was asked, I believe, is at the 2006 annual meeting, and Coke, one of the great investments of all time. He bought Coca-Cola back in the late 1980s, and by the late 1990s, 13 years later, Coke had doubled and doubled and doubled many times over. He'd made a ton of money, but the stock was trading at 50 times earnings or something at the peak of the Nifty 50 bubble for a relatively slow, steady grower. Coke is not, you know, growing in the teens or 20%, you know, level like these tech companies. And he was asked, after the stock had sort of fallen by 50%, when the bubble, the quality bubble burst, you know, even though the company did fine, he was down 50% from the peak on the stock. And he was asked, why didn't you sell some, at least, you know, sell half, when it had reached what was obviously a very high nosebleed valuation? And he shrugged his shoulders and said, I should have. And so here he is, faced with a very similar situation with Apple, where he made almost 10 times as money since he started buying the stock 6 or 8 years ago. And I think he didn't notice, he didn't dump it. I'm not saying he should have sold the whole thing. He sold half, but he waited. I mean, you could have argued he should have sold half years ago after the stock doubled or went up 5x, but to his credit, he was patient. So my main message would be to hang on to these great long-term compounders. Only a handful of stocks. Let's say you own 10 stocks. 2 of them are probably going to drive all of your returns over a 5 to 10 or 20 year period. But the key is you better hold on to those 2. So instead of dumping the stock, just because the stock doubles doesn't mean you sell half of it. Warren Buffett didn't sell half his Apple till it went up tenfold. That makes a lot more sense. But if the stock starts to pull back, you don't want to see an 80% drop, and we have seen 80% drops just in the past few years in Netflix, in Meta, i.e. Facebook. You know, if you've made an awful lot of money, you don't want to give 80% of it back. So maybe you hang on to it, but with a trailing stop on it.
But gee whiz, they've certainly done well since then, and the stocks have done what they've done. Then you were probably better off just riding that 80% or 50% decline and just kept owning them, right?
Both Netflix and Meta were stocks where, you know, when they got cut in half, I was telling my readers, hey, these are super interesting here. And then they got cut in half again. And so anyone who followed my initial advice lost half their money. But I said, this is the buying opportunity of the decade, down 75, 80%. And I have not recommended exiting those positions now that they've regained and in the case of Meta, exceeded their former highs. Meta's up 5x in the last couple of years since I pounded the table on it. So if you're right on the company, you don't need to precisely time the bottom on the stock. Trying to get too cute in timing the bottom is generally, a sucker's game.
I mean, timing a top is difficult too.
Right. I hope the overall message is look for quality companies. Ideally find ones that are beaten down, out of favor, and you can pick up their stocks cheap and their problems turn out to be temporary or cyclical in nature. And so, a couple that I'm looking at just right now that have really gotten beaten up would be examples like Nike and Starbucks. The fallen growth angels where you're betting that they can fix their problems, return to growth, as opposed to piling into stocks at their all-time highs, trading at double their historical valuation multiples, like Apple or Costco or Nvidia.
Looking at one of the things that you've written is, your favorite type of stock, a long-term growth company, down at least 50%, due to short-term headwinds and fixable problems. So do you think these are short-term headwinds and fixable problems, for instance, with Nike and Starbucks?
It's interesting. Starbucks just replaced their CEO. They poached the CEO from Chipotle, Brian Niccol, who there's an interesting story there because when he came in 2018 to Chipotle, you recall that Chipotle had problems with people who had gotten sick eating their food. The stock had really sold off. And he came in and, the stock went up tenfold. And by the time he exited, I think it was up ninefold since he came in only 6 years earlier. So I think he's the perfect new CEO for Starbucks. And I love betting on these turnaround specialist CEOs. And Starbucks, keep in mind, isn't a broken company in any way. It's still an incredible, highly profitable business. But the stock's off, 40 odd percent from its peak a few years ago. They've struggled. The last CEO was not a good culture fit. I think they've now got the perfect CEO in there. So that's one where, the stock today, I think they're probably under earning a little bit. So earnings may be a little bit depressed, but the new CEO is coming in. It was trading at 40 something times earnings.
Okay.
So earnings is sort of flatlined. The multiple's compressed quite a bit. I'm willing to pay high 20s multiple of earnings if I'm convinced that this new CEO is a good culture fit and he starts really fixing things. I think there's a lot of low-hanging fruit at Starbucks. Interestingly, for example, the CEO coming in is a food guy. He's not a beverage guy. His history was first at Taco Bell, turning around and fixing that, then came and did the same at Chipotle. Starbucks is a place that people don't think of to go for food, but they have millions and millions of people going through their stores every year. Imagine if he develops some great food products to supplement their incredible coffee and beverage business, right? Boy, at that point, Starbucks earnings double, the multiple goes back up into the 40s, and you make multiples of your money. So I'm hoping to sort of get lucky here that, maybe the stock sort of stays cheap for the next 6 months or so. We can hear him lay out his plans. We can see that he's starting to execute on those plans and the stock doesn't run away from me. So Starbucks is definitely sort of on my hot list right now, but he hasn't even taken over yet. They just announced this recently.
Right.
Another example, Nike, is I just saw my friend, college buddy Bill Ackman, one of the biggest and most respected and most successful activist shareholders, investors over time, and he has in at least a half dozen cases in his career pushed out underperforming CEOs, brought in new CEOs who unlocked tremendous value, and the stocks did tremendously well. I have no doubt that that's his plan here with Nike. The current CEO has really screwed up that business in the last 3 years. And so I think he's buying the stock with a plan to replace the CEO, doing just what Starbucks did this week.
And I will state, two things. Number one, that this is not inside information you don't know, but you're just looking at how
Right.
Bill Ackman has acted as an activist investor in the past. that,
Sure.
that there might be that same behavior
Yes.
might be applied.
I've deliberately not called Bill and asked him since the news broke that he was buying Nike because I wanted to be able to speak freely. So I have absolutely no inside information, certainly from the company, nor have I spoken with Bill about his plans, but I know Bill well. I've invested, I've ridden his coattails a number of times when he's gotten into these companies and like Canadian Pacific and there's so many examples where he's been a very effective activist, and part of that is replacing an underperforming CEO often, and I suspect that that's what will happen here.
So, Whitney, I also should add that since you are now the editor of Stansberry's investment advisory newsletter, you're not allowed to own individual securities. Is that correct? Or certainly any individual securities that they own in the model portfolio, for instance, right?
Correct. It would be a conflict of interest, and
Right.
we always put our subscribers first. I was pounding the table on Meta at $90, and it's at $500 today. That was a once every few years back up the truck opportunity of one of the world's greatest businesses. Stock was down 80%. You just don't see that very often.
In your Stansberry Investment Advisory newsletter, there is a model portfolio, and it has different categories. I was intrigued. The gatekeepers of the financial markets, which
Yes.
are exchanges. So that's one major area. Do you want to just quickly explain what the attraction
Sure.
is?
Not just in the United States, but around the world. If you look at the stock exchanges, the Bolsa in Brazil, here in the United States, everyone thinks of NASDAQ and New York Stock Exchange, but you have the Intercontinental Exchange, ICE over in Europe. In the United States, you have CBOE, which is where the options and commodities are traded and so forth. It's sort of a natural monopoly kind of business, and sure enough, if you go back and look at the stock exchanges as businesses and how the stocks of stock exchanges have done around the world, in every country we've ever studied, the stocks of the stock exchange have done better than the market index. So the Japanese stock exchange does better than the Nikkei. The Brazilian Bolsa stock does better than the Bolsa. You know what I'm saying? So that's a theme that we've identified and made a number of profitable recommendations to our subscribers over the years there.
At the end of every Wealth Track, Whitney, we ask each of our guests for one investment recommendation for a long-term diversified portfolio. What would yours be?
Can I give 3 quick answers?
Sure.
Well, one, for the vast majority of people, just buy the S&P 500 and forget about it like my sister's done, and she's done better than 90% of everybody else, right? Number 2 is Berkshire Hathaway I view as a little bit better than the S&P 500. Not quite as diversified, but as the foundation for any long-term portfolio. I think Berkshire will do a few percentage points better than the S&P over time. But I would comfortably put 100% of my sister's retirement fund in the S&P 500. Berkshire, maybe not 100%, maybe 20% or something. But Berkshire is probably the only company I would say where I'd say put 20% of your you could put 20% of your retirement fund in it. And then as a more active stock idea, I've talked a lot about Nike here. You want to buy an insanely great company when it's been cut in half, and there's some sort of catalyst that might cause it to re-rate. And I think the news that we just got that my old friend Bill, who's done this at least a half dozen, if not a dozen times over the last 15, 20 years, I think he's probably going to do it again here. And it's going to be hard to lose money over time because Nike, even totally mismanaged, if you actually look at the financials, the company is still minting money. When Facebook went down by 80%, this is now Meta Platforms, the earnings were down by 40%. Here, Nike's earnings are down 7%. And the stock's down 50%, right? Those are the kind of disconnects you look for. And then ideally, you can hop on the coattails of a smart activist who can help turn things around.
Whitney Tilson, thank you so much for joining us on Wealth Track for the first of a 2-part interview. I'm looking forward to the next one. Thanks, Whitney.
My pleasure.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. Whitney Tilson contributed to the wonderful book of Charlie Munger's writings, so I am going to recommend it again. So this week's action point is read the recently reissued edition of Poor Charlie's Almanac, the essential wit and wisdom of Charles T. Munger. Munger, who died late last year at the ripe old age of 99, was the billionaire vice chairman of Berkshire Hathaway. A legendary investor in his own right, Munger was Warren Buffett's closest friend, longtime business partner, and advisor. Buffett dubbed him the abominable no man for vetoing numerous potential investments over their 6 decades together, and credits Munger with changing Buffett's original Graham and Dodd deep value approach of buying cigar butt investments, those are mediocre companies at bargain prices, to one of buying splendid businesses at reasonable prices. Poor Charlie's Almanac is a collection of 11 of Munger's talks over the years on topics ranging from investing to academia to the personal habits and qualities that will lead to a success or failure in life. Buffett said recruiting Charlie was his greatest investment accomplishment. Reading Poor Charlie's Almanac will be a great and entertaining investment of your time and perhaps a source of inspiration. Munger advised, spend each day trying to be a little wiser than you were when you woke up. Well, next week, legendary global investor Bill Wilby on market excesses and how he is positioning his retirement portfolio. It is a WealthTrack exclusive. In this week's extra feature, why Whitney Tilson has made the pilgrimage to Berkshire Hathaway's annual meetings for more than a quarter of a century. If you have a chance, please follow us on Facebook, X, and our YouTube channel. Thank you for spending time with us. Have a super weekend and make the week ahead a healthy, profitable, and productive one.